Hello, everyone, and welcome to The Buck Stops Here. I am Catherine Murray. Well, it certainly seems a perfect opportunity midsummer to get a top-down view of the markets and how to best position ourselves for the remainder of the year. For this conversation today, Paul Christopher is joining us. He is head of global investment strategy at Wells Fargo Investment Institute. Paul, great to have you with us. I really appreciate your time. Thank you.
Thank you, Catherine. Great to be here.
Thank you. Let's start with the top-down view. I mean, it feels like it is kind of the midsummer, but these markets keep charging on. What is your macro position right now as it relates to the economy and the markets?
Yeah, hard to believe we're already into August and school's getting ready to start again. What we're seeing is basically some pretty considerable resilience in the economy. Yes, it's the fact that your lower income households are suffering a little bit from having drawn down their savings, run up their credit cards, and in some cases, auto loans are in danger of repossession. So there's that problem. But middle class consumers are doing quite well, and of course, the upper income households who can bank on their stock market performance and their capital gains, they are doing quite well and really carrying more of their share of the water. So from a consumer spending standpoint, overall, the condition looks pretty resilient to us. What's more, we're also seeing job gains benefiting disproportionately those lower income households. So we don't think they're hanging on by their fingernails either. The other
Hmm.
piece that we want to consider about the macro economy is the strong spending that we're seeing in technology, especially artificial intelligence. You know, when you take the total spending on technology and divide it by the total size of the economy, so you get a sort of a proportional look. The spending that's going on today in proportion to the size of the economy is only matched by historically in the US what we saw with the development of the railroads in the 19th century. That's how significant this disruption we think is going to be for the economy going forward. We still see more spending this year to support the economy, and we see spending growth continuing into next year and possibly 2028 as well.
Which I find so fascinating, the comparison to the build out of the railroads in America. That is how I'm also looking at it. The question, though, and this is why we have seen volatility in the market, is it too much spend? And will the spend be rewarded? And is it too much of a
Mhm.
circular reference with respect to companies paying for chips that then can they invest in the capex? There's so much circular referencing going on that is of concern. Where do you stand on this?
Yeah, that's right. So that circular referencing really refers to companies making contracts with other companies to buy things from them. But if the company that's doing the contract, that's doing the buying, runs out of money, well, then you're not really generating new spending. You're actually kind of folding things up in a faster way, if that makes sense. So the circular
Hmm.
referencing is something to keep an eye on, but it's part of a broader picture of capital spending in the economy that's going on. And first, I want to differentiate. Technology spending, broadly speaking, has been going on for years. We all know that if you call your bank, you call different companies, you're going to get an automated phone line. That sort of technology has been around for a long time. Robotics also have been around for a long time. So that technology is already benefiting us. But the technology spending we're talking about is really related to artificial intelligence. And your question is the main one that markets keep coming back to, and that is, how do we know that this spending is going to generate profits over a longer period of time? Yes, we see the earnings in the first quarter, we see the earnings in the second quarter, but if I'm going to pay up for a hyperscaler, if I'm going to pay up for one of those big technology companies, then I want to know that I'm not overpaying regarding the future earnings, let's say 27, 28, and beyond. And frankly, the answer to that question is nobody really knows. Okay, nobody
Hmm.
really knows, because you just don't know what the rate of adoption is ultimately going to be. And if we think about the late 1990s and the early 2000s, the same questions arose. I'm not saying the results are going to be the same, mind you. I'm just saying the same questions arose. This is a disruptive force, the internet, private personal computers, and Windows, all that technology. That was a disruptive force in the late 1990s. It is the AI is a disruptive force in the same way today. We can see productivity starting to improve, and we believe that artificial intelligence will have great adoption and will increase productivity further and generate earnings. But we don't know exactly how soon, and we don't know exactly which company. So if you think about what was the first PC that you ever owned, name brand, it's possible
Yeah.
if you bought that machine in the 90s, that company is no longer around.
Paul, as you were saying, we can liken the AI disruption to the computer area. Which PC did we have back in the 90s? And that company might not be around. And we can also liken it to the dot-com boom. We didn't know which companies were going to survive or not. I was actually doing equity research back at William Blair in the day. And if you put a dot-com next to any company name, the stock shot up easily 100% that morning. And again, many of those companies aren't around. So, how do you, from an investment strategy perspective, plan for this?
Well, you can't really plan for it. And again, a lot of humility is necessary here to recognize what we can know with research and what we cannot know with research. And right now, we don't know how quickly AI will ultimately be adopted across the economy. We're seeing it in places, yes, but we don't know how quickly or broadly yet that will happen, the pace. But we do feel like it will happen. And moreover, we don't know which companies will end up surviving. Those that can use AI to make more money and actually do so, obviously, those ones will survive. We don't know yet. So, our investment strategy is really based upon the idea of play the trend, but don't overpay. And so, several
Mm,
times since 2023, we have been overweight the information technology sector of the S&P 500. And then as it got expensive, we took profits and rolled those into other areas that we think are important for AI development, like data centers, but that didn't look as expensive, that hadn't been bid up in price by quite so much. Because it's that bidding up in price that then, when there's disappointment, the shock comes when the price falls very quickly. The investor loses quite a lot in a short time. So it's better, we think, to play the trend but not overpay. And what we did was we'll take profits, for example, and we'll go into utilities. We'll go into
hmm.
industrials. Why? Those are currently favorites of ours. They're not expensive, we think, and they're both going to be involved in data centers. And whichever companies win the race in AI, they're going to need data centers. So you're betting on, we think, a surer thing in
Hmm.
terms of data centers being needed, and we're going to do it in a cheaper way, and we're going to get out when the prices get too high, and then we're going to look for some other way to stay involved
Right.
in that trend, but not overpay.
Yeah, it makes a lot of sense. If people can remember back to the early 2000s and the dot-com boom and bust, there were many companies that, if they were trading at 50, 70 times, fell right back down to a market multiple and then took well over a decade to recoup any of that loss from a stock price perspective. So I can appreciate exactly what you're saying. Curious though, when we take a look at utilities, what is the multiple now? Because going back a year or two, they were in such vogue, which was very odd, I think, for utilities.
Yeah, so you're looking at low 20s still for utilities. Industrial's a little bit more expensive than that right now. We're taking a look at that one, but it doesn't look like the 50 or 70 or even 30 multiples that you were describing a moment ago for those dot-com companies.
Right. When we take a look at materials right now, can you describe a little bit more about what the investment thesis is for that area?
So again, go back to the benchmark theme of for us, which is play the trend but don't overpay. And if you're going to be building out technology, you're going to be building out data centers, and we already have from this current president, from President Biden, we have a recognition, and from Congress over the last 6 years, that we need to build out our infrastructure better. Our industrial infrastructure and especially our electrical infrastructure. That's going to mean a lot of materials. It's going to mean metals like aluminum and copper to run wiring. It's going to mean other materials that, let's say, fertilizers. It's going to mean ammonia that you're going to use to refine the copper and turn into sulfuric acid so you could refine metals. So there's a wide variety of materials that we think are going to be important going forward here, and we're in a competition globally for these
Hmm.
materials with China. And that's going to be important too. We can see companies doing what they can around the world to shore up their supply chains and create redundancy in supply chains in case one or another of them goes away. So, materials are going to be, we think, an important piece of playing this trend, playing the theme, but not overpaying.
Hmm. Right. And what about energy, real brief, before we head into the next segment? Because I do feel whoever can control the materials as well as the energy will be the power players of the future.
That's right. And the U.S. has a tremendous advantage here in terms of natural gas, at least, and also in crude oil. Right now, we have a fair amount of volatility in the energy prices because of the conflict in the Gulf. We're going to be playing that one a little bit cautiously as we wait for that conflict to wind down. But there are metals that we can play, industrial metals that we like even better, and we like precious metals as well. So we would keep an eye on energy, but stick with the metals for right now.
Okay, we'll take a quick break. We'll be right back. Paulo, I'd love to get your thoughts on the rest of the world outside of North America or United States in particular. But there's been so much focus on the Kospi, South Korea. Can you explain what's been going on and how we should be looking at that market? Because it is such a concentrated market and it also has a lot of leverage in it.
Yes, that's exactly right. And those are the two main risks. But let's talk a little bit about the opportunities too. South Korea and Japan have been suppliers of electronic components to China for a long time now. And many US companies even had more elaborate, let's say 10, 15 years ago, before the competition between the US and China heated up. US companies had arrangements where you produce some parts in South Korea, send them to China, do some assembly, send it back to Korea, and then perhaps send it back to China for the final assembly. Today, it's more regimented than that. South Korea and Taiwan are producing quite a few of the chips that are being used. China's buying some of those. The U.S. is buying some of those. And as you point out, the problem is that you get to these very large South Korean conglomerates. They're highly concentrated, and they could make mistakes in terms of how much they allocate for investment, or if their earnings disappoint, and then suddenly the markets sell off in a very big way. And that's kind of what's happened to the South Korean Kospi in the last several weeks. For a long-term U.S. investor, first of all, U.S. investors haven't been heavily invested in emerging markets. Number one. Number two, they're a little bit mistrustful of as you get closer to China. We think the way to manage this is probably with a broad-based emerging market exposure, maybe with a focus on Asia and South Korea, but not exclusively South Korea and not exclusively Taiwan. You've also got the ASEAN countries, Southeast Asia, which are taking quite a lot of the low value manufacturing functions that China used to perform for the rest of the world. And they're making those goods and selling them to the Chinese as well as to US companies. So there's actually a broadening perspective or a broadening base, we think, of opportunity in emerging markets where you don't have to get invested in China directly, but you can play the countries that are working with China and developing as China's economy expands and becomes more advanced. And that's, I think, how we would do it. That would help take care of the problem of the concentration in the South Korean market, and it would take care of the problem of, gee, really wanting to invest in China, but not really trusting how the laws there might work for or against US companies today, tomorrow, or next year.
Right. So is the view then in terms of investing in emerging markets, and there are many ETFs that people can use to do that, is the view that more of a growth oriented investment thesis, or is there value, or both?
Yeah, it's a great question. It's really a growth thesis for emerging markets right now, and we would think about a portfolio that has a U.S. equity allocation and an emerging markets allocation. That would be Asia, for example, Latin America for the materials, by the way. We would
Mm.
take that allocation and we would be sticking to it. We would just be neutral right now. We wouldn't want to take money away from the U.S. And overweight emerging markets, but we do want to have an allocation would encourage U.S. Canadian investors to consider that as part of the portfolio as a diversifier. The AI development in Asia is going to be, it's running in parallel, but it's a little bit
Mm.
different from how it's running in the U.S. And so there's a potential for some diversification. You just want to watch out for that concentration risk and the risk of investing directly in China.
Right. And bringing it back to the United States and investing, we've talked a lot about equities. What are your views right now on the fixed income market? I was listening to an interesting podcast the other day, the All In podcast. I don't know if you listened to that, but they were talking about, potentially being interested in investing in the 30-year treasury because of the yield that it's providing. I'm not saying that that's maybe something to do now, and I believe that you're more on the short-term part of the curve. But how should we look at fixed income in the portfolio today?
Yeah, well, just as it may sound like we were all gung ho for equities, but we're really pretty selective in equities, following that play but don't overpay trend. The same is true for fixed income. We want to be selective here because what we're seeing on the long end of the maturity spectrum, say 10, 20, 30 years out, we're seeing quite a lot of up and down in yields. And especially when those yields move higher, then we worry that the yield that the investor gets may not compensate him or her for the loss in price. Because, of course, when yields rise, prices fall. So we don't want the
Hmm.
total return, the investor to lose sight of the total return just going for yields. And maybe we can talk a little bit more about that and how we
Sure.
come up with our guidance.
That sounds great. We'll take a quick break. We'll be right back. Paul, it's interesting. There's a lot of discussion right now regarding the new Fed chair and whether or not more or less communication is better for the markets. Where do you stand on this? Because it does dovetail into our fixed income portfolio.
Yeah, so the new Fed chairman has been adamant that the Fed will hit the 2% long term inflation target, but inflation really hasn't been at 2% for some years now, and part of that is just a function of the big infrastructure spend that we're seeing in this country, and maybe the Fed balance sheet needs another little bit of a review too, and so
Mm.
when you see, for example, the Treasury auction come out weak, right, where there's not a lot of people who are interested in buying a 20-year or a 5-year security, then what happens is the yields start to rise. And that gets back to what we were talking about. Yields have gone up considerably, 30, 40 basis points, almost a half a percent, excuse me, almost half a percent since the end of June. And a lot of that is uncertainty about what's going to happen with issuance and what's going to happen with inflation. And if the Fed has a 2% target, and if they say, well, we're going to hit that, and typically how the Fed does that is to raise interest rates. Well, how much do they have to raise interest rates to bring inflation down a percent, a full percentage point? Maybe a lot. And
Hmm.
when would they begin? Markets pricing maybe a quarter point hike in September, but there's you might need quite a lot more than that to get down to 2%. And so markets are really wondering how exactly is Chairman Warsh going to make this happen? That uncertainty, the Treasury uncertainty, the auctions that have been on the soft side, the inflation risks that we see from the war up and down in terms of energy prices, all of these have pushed long term yields higher, which is why we have decided to really shift our focus to the shorter end, Treasury bills, CDs, right? Take advantage of those rising short-term yield rates while you can. And then when the time is right, that becomes useful dry powder, perhaps to get back into equities or perhaps to get back into longer term yields. But with yields rising this much right now, you really have to take a total return perspective. Don't just look at the yield. Consider how much the
Right.
value of your security falls when those yields rise.
Right. No, that's a great point. And there is a lot of uncertainty in terms of raising rates and also the tariffs and whether or not, I mean, this is always debated in terms of whether or not tariffs
Mhm.
have actually had an impact on inflation and on the consumer. Where do you stand on that? I'm curious.
We did see last year, so we looked at this carefully and we saw initially the tariff burden was being paid by foreign companies, the company, the factories, the Chinese factories, for instance, that would make a good and sell it to a US company that would then import the good. And then as the year went on last year, we saw the tariff burden shift to US firms. They were the ones paying the tariffs. And then by the end of the year, we were seeing more of that being passed along to consumers. And we're seeing more and more of that now. So when we look at goods prices outside of food and energy, and we only exclude food
Hmm.
and energy because they're so volatile. When we look at other goods prices, we see them rising in part because of tariffs and in part because the industrial goods are being demanded by computer companies or tech companies to do their AI purchases. And so these things are all working with the energy together to raise overall inflation.
Hmm. It doesn't seem as though the market's really pricing the rate height risk accurately. Maybe, but
If you
earnings are very strong and the economy's strong, so maybe it is accurate.
If you look at the short end of the maturity spectrum, no, the markets have maybe two, or maybe two and a little bit, two and the chance of a third priced in by the end of next year. But if you look at the longer end of the maturity spectrum,
Mm,
that's where we think more sensitivity.
okay. Real brief here. Where do you stand on Fed share wars? Should we have less communication or more? He's leaning to less with the market.
He's leaning to less. And, we had a period of less communication during the 1980s. And what ended up happening was that the Fed expected the market to move first, and then the Fed would move. And so right now, the
Hmm.
markets are trying to decide, well, are we going to move, and how much and how soon? And they're just not used to that. I think investors since 1994 got used to the Fed saying, here's what we're going to do, more or less, and here's the timing of it. And right now, the markets are trying to figure out what their role is in what the Fed expects the market to do. So it's going to take a little while. And again, we're going to see that uncertainty play out in terms of higher yields in those 10 and 20 and 30-year maturities, and maybe a little bit more reticence to start to add rate hikes at the short end. So stick with those short-term maturities for right now.
Okay. Okay. Paul, great to be with you. Thank you very much for
Thank
your
you, Catherine.
valuable insights. Thank you. And thanks for watching. We'll see you next time.